Hey, what's up, everyone? Welcome back to my world of stocks. Just a quick heads up, I'm actually very sick. I have like strep throat. My throat is all messed up. So I apologize if I sound a little off, if my energy is a little low for this video, but I'm pushing through. It's actually like midnight right now, so I'm recording really late too. But yeah, I just wanted to do this video for you guys because really we've had some shocking developments over the past year with Warren Buffett dumping his Apple shares, his number one largest holding. He's been selling it, guys, by giant amounts. And according to some new SEC filings, well, it looks like Berkshire Hathaway continues to be a seller to this day. However, what it also showed in these new filings is that Buffett actually just picked up two brand new stocks instead, along with an increase to three other stocks that he owns too. So you know that we had to cover this. I'll give you a quick recap of the Apple selling, and then I'll also share my thoughts on the two brand new pickups for Buffett and the three other increases as well. And what the heck, I might as well rank all of these stocks for you too, since that's something that we like to do on this channel. But let's not waste any time, guys. Let's go ahead and jump straight into this here. Now, just to get this out of the way, Buffett has now sold 115 million shares of Apple in the first quarter of this year. Then he sold 390 million in Q2, and now an additional 100 million shares in Q3, which altogether was close to a 70% reduction. And based on today's share price, well, it would amount to over $150 billion of sales in Apple. Now, just to be clear, even with all of that selling, Apple is still Buffett's number one holding. It's worth about $70 billion and about 25% of his overall portfolio. But obviously, that was a disgusting amount of selling there in Apple stock. And really, the biggest reason for that, I feel, is because of really just how much Apple has already risen, skyrocketing to a new all-time high in recent years, to now being literally the most expensive stock in the world by market cap at over $3.8 trillion. Now, look, I own a little bit of Apple stock myself, and I love how sticky and profitable their business is. But when you're trading over $500 billion more than Microsoft and over $1 trillion more than Google and Amazon too, well, I can totally understand wanting to take some profits at those levels. In fact, if I was given a choice at today's prices, I would rather have any of those other three stocks over Apple. So it's not surprising to me, and of course I'm talking about Amazon, Microsoft, and Google, and so it's not surprising to me here to be doing some trimming there at these levels. It's just a little shocking by how much Buffett really sold, which I think was also a bet on the market overall just being too high right now, as Berkshire has now increased their cash pile by 17% just these past 2 quarters, up to over $320 billion. That tells me that Buffett really wants to have a giant cash pile on the side to really be able to either acquire almost any company, that he wants, or also to be able to deploy that in the market if it happens to fall back down at more attractive levels in the stock, the stock market overall. With that said, though, Berkshire Hathaway did already do some buying recently. This just got reported to the SEC. So let's run through the 5 largest purchases that they just made, and we'll go from smallest to largest position. And the first of those was actually a brand new addition to the portfolio. It was in Pool Corp, ticker symbol Pool, P-O-O-L, which was a purchase of more than $150 million. Now, if you've never heard of this one, guys, they're a very large wholesale swimming pool and supplies and services company. In fact, they're technically the largest in the world, not only selling pools, but, of course, installing them, maintaining them, and even repairing them too, as well as just selling all of the supplies that pool owners might need. It might not be the most exciting type of business out there, but being a market leader in a niche kind of, area like that has actually led to a lot of success for the company. Unfortunately, though, being that dominant in your market, well, it also leaves you pretty vulnerable to the macro economy when you're doing so well in your niche kind of area. Macro economy can really affect your business. And we saw a direct example of that in their sales that soared around the start of the pandemic because of all the stimulus money going into people's pockets. And that made it easier for them to, renovate their homes, maybe install a new pool or fix and upgrade their existing one. But then, as soon as all of that stimulus ran out and we were left with high inflation and high interest rates, well, the economy obviously took a dive, people struggled more, and Pool's revenue came falling right back down with an 11% drop last year, and another 4% drop expected this year, too, for their sales. Having some cyclicality, it could be, I would say, fine though for a Warren Buffett type of value dividend kind of stock, because if the price falls, well, it can drag that valuation down and send the dividend rising, which are all things that Buffett really loves to have in his, type of stocks. We always see that with Buffett stocks, value and dividends and things like that. So being volatile, having that exposure to the macroeconomy may not be the worst thing, but while this one does have a strong business as the market leader, the other two variables are really lacking here in terms of valuation and dividend, as even though the stock price fell by about 40% recently, their forward PE ratio still hovers around 60 to 80% higher than the sector, while the dividend, despite having some excellent growth metrics on it, only yields less than 1.4%. Meaning that it would likely take years until it even is able to grow large enough to keep up with inflation. So I'm not a big fan of this one myself, guys, and I actually just put out a best dividend stocks video for 2025 where I listed many different value dividend stocks that I think are much more attractive than this one. I'll be nice though and rank it at number 3 for now because we still need to see what else is on this list, but it's not a stock that I'll be picking up myself. Well, coming in at purchase number 2 though, we actually have the other brand new pickup from Buffett, which has also been getting a lot more attention recently, and that is the pizza giant Domino's, ticker symbol DPZ, which he purchased almost $550 million of last quarter. Now, when it comes to Domino's business, I tend to avoid these types of fast food kind of retail stocks myself just because of how saturated and competitive the market is, making it a little harder to keep up with everything going on there. However, I will say that on a more personal level, I'm actually a fan of Domino's and their brand. Out of all the fast food pizza shops, Domino's is actually my favorite. I like the taste more than like Pizza Hut or Little Caesars. And the online app is super easy to use where I can customize everything. I usually do like a handmade pan pizza with Alfredo sauce, mushrooms, and chicken, maybe some pineapple. This is starting to sound like a commercial for Pizza Hut, but for Domino's, I mean. But I have actually used them in the past, and it was a good experience. And they also tend to have a lot of coupons too that makes it a little more affordable. So just the overall experience I've been a fan of with Domino's personally, just me. But I'm not the only one, I'm guessing, because Domino's has actually grown into the #1 market share leader as a franchisor, with still more room to grow in the future, given the roughly $95 billion estimated market size worldwide, which they have a pretty large presence in across more than 90 different global markets. Plus, their new More initiative will launch another 5,000 new stores in the coming years to help keep their already large growth rates versus the competition, many of which have actually been in decline throughout recent years. However, for as good as Domino's performs in relation to their peers, their overall growth as a company itself is still too low, in my opinion, to justify the valuation. Now, the stock has actually dipped a little from the top, losing about a quarter of its value, but even here, it still trades around 30 to 50% more expensive than the sector based on PE and PEG ratios. That's just not going to cut it for a business that is only growing sales by around a mid-single digit percentage on average, nor is the really small dividend of less than a 1.5% yield. Now, granted, that dividend does at least have some excellent growth metrics on it, so perhaps Buffett was looking for just another kind of market leader with a growing dividend similar to Pool, what we saw with Pool, right? But like I said before, I just think that there's way better options out there for any of the attributes that we're talking about here. And for that reason, I'm ranking them number 3, giving them just a slight edge over Pool, since I've at least bought from Domino's on occasion. I want to eat healthier, so Domino's is not really something I eat often. But, the fact that I have used it before would probably make it a little easier to keep track of the business and their operations and understand them a little better than something like Pool, because I don't even have a pool. But anyway, moving on here. As much as I don't like these first 2 stocks, though, Thankfully, purchase number 3 is actually one that I own myself, and that is Verisign, ticker symbol VRSN, which he just picked up another 234,000 more shares of, now making up over $2.5 billion in the portfolio at just under 1%. And yeah, this one I do actually like a lot. Verisign is the largest internet top-level domain provider in the world, basically managing and securing the infrastructure behind .com, .net, .edu, and other similar domains, which are provided to other companies for a recurring fee. It's not a stock that gets talked about very often in the mainstream, but it's a great overall business that I feel is very sticky and not likely to ever go away. As such, financials are typically strong with consistent mid-single digit growth every year. And while their growth rates are not anything special to send the stock skyrocketing in the future, I do feel that they're at least reliable enough to keep the stock performing well long term. Plus, a recent dip of about 20% left it trading cheaper than their own 5-year average and the sector median by around the same amount on a GAAP PE basis, which I feel is very attractive for a proven leader like this. If I was to be really kind of picky about Verisign, though, I would probably say that it's just a little too boring of a business, of a stock to not be paying any dividends. But for what it is, I think it's a good enough value type of stock to hold long term. So I'm ranking them higher at number 2 because of it. All right, guys, that'll leave us now, though, with the final 2 remaining purchases. And coming in at number 4, we have another one here that's been getting some buzz lately, and that is SiriusXM, ticker symbol SIRI, at a 12 million shares increase, bringing the stake up to over $2.8 billion and worth just over 1% of Buffett's overall portfolio. Unfortunately, though, one of the reasons why it's been getting talked about so much is because of how much the stock has actually cratered in recent years, which I can understand the interest in that, being negative over the past decade, while also losing about 70% of its value from the top, leaving behind a dirt cheap valuation on practically any metric you look at, while also raising the dividend yield up to over 4%. All of that alone would normally be, something attractive to consider. However, that's only if the business is stable enough to help the stock recover long term, which it could be, but I personally have never had much faith in Sirius. Now, you guys know the business here. They're basically the only name worth talking about in satellite radio. This coming after the 2008 merger of Sirius with XM Radio, before later acquiring Pandora as well to form what many thought would be an entertainment powerhouse, especially back in the day when Pandora was a lot more popular. A lot of people used it to stream music for free. You couple that with SiriusXM, which was always this kind of like premium radio service, had higher quality. It was often bundled on infotainment systems on newer cars. So it was always kind of like this thing that felt like it would be the future of radio and stuff like that. This was back in the day when these services were very popular. But you fast forward to present time, and the market has really largely shifted away towards other massive brands in online streaming like Spotify, Apple Music, YouTube Music, Amazon Music, and even Tencent Music in China. Guys, these are some of the absolute largest companies in the entire world, so they can afford to subsidize their streaming services to gain market share. And that's exactly what's happened over the years. Now, Statista doesn't list Sirius numbers on this page because they consider satellite to be a separate market in itself, even though I would lump it all together as direct competition. But for comparison, Spotify currently has like over 250 million subscribers, with most of the others hovering around 100 million too. But Sirius, on the other hand, it only has around like 40 million paid. That's if you combine it with Pandora. So around half the size of most of the competition, while Pandora has also been losing millions of subscribers in recent years too. But overall, that's caused their financials to struggle, with 3 years of slight revenue declines now expected, with just about flat profitability too. Last quarter, their free cash flow even plummeted by over 60%, which I'm sure was mostly due to the recent restructurings that they did with Liberty Media. But overall, it just feels like a very up in the air type of business with also massive competition, to where it's just too difficult to predict where they'll end up long term. So I'm ranking them at the bottom here at number 4, since I would at least have stronger faith in the other businesses instead. With that said, though, we're left now with the final purchase of the list, and it's a Buffett stock that I've covered a lot before in the past, and I'm also not a big fan of it, and I'm also really feeling the sickness right now, so I'm just going to do a really rapid fire of this one, do it really quick for you guys, finish off this video. But that is the oil giant Occidental Petroleum, ticker symbol OXY, which he continues to add more of, bringing the stake up to over $12 billion and worth over 4.5% of his portfolio. But as I've said many times, Buffett really got special shares and dividends with this stock for having helped them acquire another oil giant called Anadarko. And that has since resulted in Buffett being able to collect massive dividends from the stock, even when they cut that dividend for regular shareholders. Nothing against Oxy, but in my opinion, it's just a fairly boring overall oil stock with an even richer valuation than the sector and a mediocre dividend of only less than 2%. For that price, I'd rather buy something like Chevron, who at least pays a dividend of above 4.5% if I really want to have an oil stock. So I'm actually going to rank Oxy even lower than Sirius because of how expensive it is. Leaving us with our final rankings here is pretty much just VeriSign at the top, followed by a bunch of stocks that, in my opinion, are just kind of like boring legacy type of companies that I think Buffett likely sees some value in, but I kind of feel like he's living maybe a little bit too much in the past and would probably be better served by buying more growth-oriented companies for the future. But that's just my opinion, guys. I can't go against the legendary Buffett here, and I still love tracking his moves regardless. I think it's fun to look at, and so I hope you enjoyed this video yourself too. But hey, let me know if you agree with my rankings. You want to share any thoughts, agree with anything I said, let me know down below. I hope you're all doing well, my friends. And yeah, if I missed you guys, but Merry Christmas, Happy Holidays. I hope you have a great New Year's coming up here, and I hope you're all doing well, my friends. I wish you the best out there, and I'll catch you in the next one. Thanks for your support. All right, take care, everybody. Bye-bye.